Today we'll be taking a look at the retail REIT stocks. Last time we took a look at healthcare and residential REITs. If you want to see those videos, I'll link it in the description box below. These retail REITs focus mainly on retail real estate, which would rent space out in those properties to tenants. They focus mainly on large malls, strip malls, and outlet centers. First, a disclaimer, I just want to say I'm not a financial advisor, so please do your own due diligence before investing. We will be taking a look at 6 retail REITs today. Of course, if there's one that I missed that you would like me to take a look at, please let me know in the comment section below. I'll make sure to include it in a future update. When taking a look at some of the basic information, right off the bat, I want to point out the massive amount of debt Choice Property has. Choice Property was a spin-off from Loblaw when they spun off most of their real estate property, so it's not surprising that Loblaw is their main tenant. Slate Retail and Plaza Retail has also a sizable amount of debt as well. When looking at their yield, they all have an excellent yield at over 5% with an acceptable payout ratio. When we take a look at revenue, most of them are trending upwards, but there's a few that I want to point out. First, with Plaza Retail, their revenue hasn't been growing in the past several years, it's been flat. And the big jump in Choice Properties revenue is based on an acquisition. Choice Property acquired Canadian Real Estate Investment Trust for $3.9 billion to help diversify its portfolio into industrial and non-retail properties. And also another thing that you may notice is that RioCan's revenue has also been slowing down a bit as well. I think the reason for this is because of their change in strategy. Because back in 2015, they started to enter into residential real estate market to diversify, and in 2017, they announced to be selling off about $2 billion worth of properties by 2019, and most of it in small urban centers. When we take a look at their funds from operations, we see a similar trend to their revenue, which is expected. Another thing I want to point out is take a look at Plaza Retail. The company itself hasn't been growing as fast as the others, and with them being stagnant the last several years, in my opinion, it doesn't look like a very compelling investment. When looking at their dividends, there's a few things I would like to point out. First, they made us a small dividend cut in SmartCentres and Plaza Retail, but Plaza Retail had a special dividend payment of 2 cents in 2014, so they didn't cut their dividend payment. SmartCentres, I couldn't find anything about that, so it looks like they did cut their dividend payment by a bit back in 2004. But they did have a period where they barely had any dividend growth, but recently in the past several years, they have started ramping up their dividend growth again, which is very good to see. We'll see how long they can keep this growth up. RioCan, on the other hand, had some great dividend growth back in the days, but in the past decade, it has been pretty flat. But we do notice a small uptick in 2018. But the main point I noticed from RioCan is that they are buying back more of their shares. Back in 2017, they had about 327 million shares outstanding, but in 2018, they had around 314 million shares outstanding. In the most recent quarterly report in 2019, they had under 305 million shares outstanding. With them buying back their shares, they should be able to grow their profits per share and in return grow their dividends again. But this is just an observation, we'll see how it plays out. When we take a look at their profit margins based on their funds from operations, we notice that they are hovering around the 40 to 50% range. But Plaza Retail has been increasing their profit margins over the years, but they did start off very low at around 20%. Even as of now, they still got some ways to go before they can achieve the same levels as the other players. When we take a look at their 5-year stock performance, we notice that 3 has been flat with no growth for 5 years, and that's RioCan, Slate Retail, and Plaza Retail. I'm a little surprised with RioCan's stock performance, but maybe that's good for us. Maybe it will give us a good buying opportunity. When we take a look at their annualized return, the trend pretty much mirrors each other again, but that shouldn't surprise us since they're all in the same field. But this year alone, some of them have really performed very well, like CT currently with a year-to-date return of over 21%, Choice Properties with a return over 17%, and RioCan with over 10% return. So in my personal opinion, which one do I like? First, let's admit the ones I'm not a big fan of. First off, let's start with Plaza Retail. They have an excellent forward yield of around 6.65%, but they have been increasing their payout ratio over the years, starting at around 60% back in 2003, but they have increased us to a high 80% range now in 2018. So there won't be much room left for them to grow their dividends if they don't grow their company, and the overall growth just hasn't been there recently. And on top of that, they do have a sizable amount of debt. Regarding Choice Properties and Slate Retail, I don't see anything really bad about them except for their debt, especially Choice Properties with over $12 billion in debt. And on top of that, Loblaw is Choice Properties' main tenant, and most of the revenue comes from them alone, so they are not very diversified. Again, another one that's not very diversified is CT Retail, as the majority of their assets are leased primarily to the Canadian Tire Corporation, which owns retailers such as Canadian Tire, of course, Marks, and PartSource. So that leaves me with my two top picks, being RioCan and SmartCentres. I like RioCan because they are the largest and they try to stay diversified by not having one tenant make up more than 10% of their rental revenue. They also get into the residential real estate market to help diversify even further. I also like how they are purchasing back their shares, to which will in effect increase their profits per share, and will maybe allow them in the future to start ramping up their dividend growth again. SmartCentres is another one that has grown very nicely over the years and recently have started ramping up their dividend growth as well, and their payout ratio has been pretty consistent over the years as well, around the 80% range. They do have Walmart as their main tenant, as it accounts for around a quarter of the rental revenue, and just under 3/4 of their properties are anchored by a Walmart. But overall, both SmartCentres and RioCan are priced very similar to each other, and in my opinion, I would purchase whichever is on sale. But I do prefer RioCan slightly more than SmartCentres, but that's just my opinion. I think they're both good. And as always, if you enjoyed the video, please like and share the video. I really appreciate it because making these videos does take a lot of time to do the research on these companies and really helps out the channel. And if you haven't subscribed yet, please make sure to smash the subscribe button. And thank you for watching. I'll see you in the next video.